Hello everyone, the topic for today's discussion is insurance. Insurance is an agreement between the two parties, in which one party gives the assurance of protecting the harm, hazard and injuries of the other party, against some consideration which is called premium. The insurance offerer undertakes to provide a guarantee of compensation against the loss, damage, illness, or death. Moving forward, if I talk about the contract of insurance, there are two parties involved in the formation of an insurance contract. One is an insurer. The insurer is the party who offers the cover of the underlying asset and charges an amount in the form of a specified premium. Second is insured. The party who buys insurance, or we can say, who agrees to the offer given by the insurer and pays the premium. At times, an agent comes into picture who connects the two above-mentioned parties. Once we intend to buy an insurance policy in the market, there is a variety to choose from. Categorically, we understand them as the life insurance and the non-life insurance. Life insurance refers to a cover whereby the policyholder can ensure financial freedom for his or her family members after death. Although a person's life cannot be indemnified for its loss, it is always invaluable, but it attempts to cover your responsibilities. We can understand this better as: suppose you are the sole earning member in your family, supporting your spouse and children. In such an event, your death would financially devastate the whole family. Life insurance policies ensure that such a thing does not happen by providing financial assistance to your family in the event of your passing. The second part includes the cover for all the materialistic things. That includes everything, from your motor vehicle to your household, to property and your foreign consignment. Thus, they can be named as life insurance, motor insurance, health insurance, travel insurance, property insurance, mobile insurance, cycle insurance, bite-size insurance if I talk about marine insurance. Marine insurance is a type of insurance that covers cargo losses or damage caused to ships, cargo vessels, terminals, and any transport in which goods are transferred or acquired between different points of origin and their final destination. It covers the losses or damages caused to ships, terminals and any transport or cargo by which goods are transferred, acquired, or held between different points of origin and final destination. The term may also apply to inland marine, but it is usually used in the context of ocean marine insurance. Moving ahead with the principles of insurance. By and large, all insurance policies obey the stated 7 principles. We can name them as: first, utmost good faith; second, insurable interest; third, proximate cause; fourth, indemnity; fifth, subrogation; sixth, contribution; and seventh, loss minimization. Let's understand these principles in detail individually. The first and foremost principle is principle of utmost good faith. As expected to the terms of a contract, nothing should be concealed or misrepresented while agreeing to the terms of an insurance contract, and it should be signed with an absolute good faith, belief or trust. The expression of full and true information is abiding for both the parties, the insurer and the insured. We can take an instance. When a person is buying health insurance policy, he might conceal the fact that he is suffering from serious diseases which are non-insurable in the policy he is buying. Possibly, if he presents all the facts completely, the insurance provider might offer a different insurance policy which covers that disease also. Moreover, in this situation of concealment, when the insured will attempt to claim the policy will be considered as null and void because of breach of terms in the contract. The utmost priority should be taken to the representation of truth and complete facts. Moving ahead, the next principle comes is of insurable interest. The principle of insurable interest states that the person getting insured must have insurable interest in the object of insurance. A person has an insurable interest when the physical existence of the insured object gives him some gain, but its non-existence will give him a loss. In simple words, the insured person must suffer some financial loss by the damage of the insured object. For example, the owner of a taxicab has insurable interest in the taxicab because he is getting income from it. But, if he sells it, he will not have an insurable interest left in that taxicab. From the above example, we can conclude that ownership plays a very crucial role in evaluating insurable interest. Every person has an insurable interest in his own life. A merchant has insurable interest in his business of trading. Similarly, a creditor has insurable interest in his debtor. Precisely, insurance cover can be taken for something which is owned by us. In the occurrence of any mishappening or accident, the owner must incur loss, so as to indemnify the actual loss only. The principle of proximate cause means when a loss is caused by more than one causes, the proximate or the nearest or the closest cause should be taken into consideration to decide the liability of the insurer. The principle states that to find out whether the insurer is liable for the loss or not, the proximate, closest, and not the remote, farthest, must be looked into. Let's take an example. Assume a situation in which a cargo ship's base was punctured due to rats and, so seawater entered, and cargo was damaged. Here, there are two causes for the damage of the cargo ship. First, the cargo ship getting punctured because of rats, and second, the seawater entering ship through puncture. The risk of seawater is insured, but the first cause is not. The nearest cause of damage is seawater, which is insured, and therefore the insurer must pay the compensation. However, in case of life insurance, the principle of causa proxima does not apply. Whatever may be the reason of death, whether a natural death or an unnatural death, the insurer is liable to pay the amount of insurance. The next principle should be understood very carefully. And the principle is principle of indemnity. Indemnity means security, protection and compensation given against damage, loss or injury. According to the principle of indemnity, an insurance contract is signed only for getting protection against unpredicted financial losses arising due to future uncertainties. Insurance contract is not made for making profit, else its sole purpose is to give compensation in case of any damage or loss. In an insurance contract, the amount of compensations paid is in proportion to the incurred losses. The amount of compensation is limited to the amount assured or the actual losses, whichever is less. The compensation must not be less or more than the actual damage. Compensation is not paid if the specified loss does not happen due to a particular reason during a specific time period. Thus, insurance is only for giving protection against losses and not for making profit. There can be three possibilities. Let's assume that the total value of the assets that we are buying insurance for is rupees 50 lakhs. First situation, when the insured buys the insurance from two different insurance providers of 50 lakhs each. In the situation, upon occurrence of any accident or mishappening, shall he be paid 50 lakhs from the first insurer and 50 lakhs from the second insurance provider separately? If this happens, he is going to be rich, without putting any efforts to get the product sold in the market. Thus, this will become the tendency of every insurance buyer. In this situation, if he has lost complete sets, then he will be paid 50 lakhs combinedly by both the insurance providers. The amount of payment contributing 50 lakhs may depend upon the terms of contract. Second situation can be when he bought insurance of 50 lakhs and the business caught fire. During the fire, some of the goods could be saved by the fire brigades. The losses due to fire were 30 lakhs. In this situation, he will be paid only 30 lakhs rupees irrespective of the total covered amount. Third situation is when the insured has bought the insurance of 25 lakhs for the goods of value 50 lakhs. Actually, he has got the insurance cover for 50% of the assets. Assuming that all of the goods won't be destroyed if any mishappening takes place. In this case, upon the occurrence of loss, the insurance provider will pay 50% off total loss value. If the total loss was of 20 lakh rupees, then he will be paid 10 lakh rupees because he has purchased the insurance of 50% value of the assets. This phenomenon is also known as principle of average. Thus, it is to be well understood that the insurance provider will not pay any amount higher than the actual loss amount. The underlying principle aims to pay off the actual losses only. However, in case of life insurance, the principle of indemnity does not apply because the value of human life cannot be measured in terms of money. The principle of contribution is a corollary of the principle of indemnity. It applies to all contracts of indemnity if the insured has taken out more than one policy on the same subject matter. According to this principle, the insured can claim the compensation only to the extent of actual loss either from all insurers or from any one insurer. If one insurer pays full compensation, then that insurer can claim proportionate claims from the other insurers. For example, Mr. John insures his property worth $100,000 with two insurers, AG Limited, for $90,000 and MetLife Limited, for $60,000. John's actual property destroyed is worth $60,000. Then Mr. John can claim the full loss of $60,000 either from AG Limited or MetLife Limited, or he can claim $36,000 from AG Limited and $24,000 from MetLife Limited. So, if the insured claims full amount of compensation from one insurer, then he cannot claim the same compensation from another insurer and make a profit. Secondly, if one insurance company pays the full compensation, then it can recover the proportionate contribution from the other insurance company. Subrogation means substituting one creditor for another. The principle of subrogation is an extension and another corollary of the principle of indemnity. It also applies to all contracts of indemnity. According to the principle of subrogation, when the insured is compensated for the losses due to damage to his insured property, then the ownership right of such property shifts to the insurer. This principle is applicable only when the damaged property has any value after the event causing the damage. The insurer can benefit out of subrogation rights only to the extent of the amount he has paid to the insured as compensation. For example, Mr. John insures his house for $1 million. The house is totally destroyed by the negligence of his neighbor Mr. Tom. The insurance company shall settle the claim of Mr. John for $1 million. At the same time, it can file a lawsuit against Mr. Tom for $1.2 million, the market value of the house. If the insurance company wins the case and collects $1.2 million from Mr. Tom, then the insurance company will retain $1 million, which it has already paid to Mr. John, plus other expenses such as court fees. The balance amount, if any, will be given to Mr. John, the insured.
According to the principle of loss minimization, an insured must always try his level best to minimize the loss of his insured property in case of uncertain events like a fire outbreak or blast, etc. The insured must take all possible measures and necessary steps to control and reduce the losses in such a scenario. The insured must not neglect and behave irresponsibly during such events just because the property is insured. Hence, it is a responsibility of the insured to protect his insured property and avoid further losses. For example, assume Mr. John's house is set on fire due to an electric short circuit. In this tragic scenario, Mr. John must try his level best to stop fire by all possible means, like first calling nearest fire department office, asking neighbors for emergency fire extinguishers, etc. He must not remain inactive and watch his house burning hoping, "Why should I worry? I've insured my house." This is all about the topic. Hope you've understood the topic. If you want something to be included, please mention in the comment section. I will certainly include in the next video.
For any feedback and topic inclusion, please write in the comment section. Please like and share the video to learn more topics. Don't forget to subscribe to the channel Autodidact to stay updated. Till then, stay healthy and happy. Stay healthy and happy. All the best.